Yeah, unemployment was 25% and people were broke and businesses were failing. It was pretty bad, but not everybody was broke and not everybody was unemployed. And there were a lot of rich people around. Just look at, Hollywood and Joseph P. Kennedy and a lot of others. But it became very gauche, I would say, to show off your wealth. Like, don't have a fancy car, don't wear a fur coat. It was just, people were suffering. Don't put on your best jewelry or your fur coat, whatever it was. That was a narrative, but it hurt consumption. It actually made the depression worse. It wouldn't have been a bad thing if people had spent money. That might have been what it would have taken to get the economy moving again. That all changed in 1933 with FDR. And remember, the theme song of the 32 election, 33 sworn in FDR campaign was "Happy Days Are Here Again." That was the Democrats' theme song. All of a sudden, the narrative shifted, and it's like, yeah, let's go buy that car, buy that house, wear a fur coat. And the stock market did extremely well in 33, 34, and 35. And it was in the middle of the Great Depression. You had a rally. Now, it crashed again in 37 and 38 because of the Fed.
In an age of market uncertainty, leverage can amplify both gains and losses. That's why seasoned investors like Warren Buffett hold staggering amounts of cash, over $330 billion, his largest cash reserve ever. Cash acts as a shock absorber, reducing volatility in a portfolio full of risky assets like stocks or gold. While it may not offer dazzling returns, it provides safety, flexibility, and crucial optionality, the ability to act swiftly when opportunities emerge as others face forced liquidations. Buffett's real genius isn't just picking stocks, it's compounding wealth tax efficiently over decades. Rather than selling stocks and triggering taxes to rebalance into bonds, he made a bold move in the 1990s, acquiring General Re, an insurance firm with a massive bond portfolio, in a stock-for-stock, tax-free deal. This allowed him to diversify seamlessly while deferring taxes indefinitely. It's a masterclass in strategic thinking, building long-term gains by preserving capital, minimizing tax drag, and reinvesting intelligently.
Over leverage is look, it's a big deal. If you're leveraged, you're going to lose. You're going to make money faster, and you're going to lose money faster. That's what leverage is. And I always recommend a big slug of cash in any portfolio, sometimes as much as 30%. And there's no better example of that today than Warren Buffett. Warren Buffett has $1/3 trillion in cash, about $330 billion in cash, the most he's ever had. Why so much cash? The greatest stock picker of all time. He isn't really, but what Buffett is the master of. He's a pretty good stock picker, but not the best. But he's the master of tax-deferred compounding. Just but tax-deferred compounding relies a lot on not losing money. So of course you want to make money, that's key. But don't pay taxes if you can possibly avoid it. That's why he bought an insurance company, because Gen Re. When Buffett, that was around, I'll say, around the early 90s, give or take. But Buffett's portfolio was very heavily weighted to stocks, and he wanted to diversify into bonds. And he said, well, what would most people do? Well, I'd sell the stocks and buy some bonds. But if you sell the stocks, you got to pay taxes. So what he did was he used his own stock, Berkshire Hathaway stock, to buy Gen Re, which had a enormous bond portfolio. So he basically doubled his balance sheet, but he equilibrated between stocks and bonds without selling any stocks or paying taxes by acquiring an insurance company, which is basically a bond portfolio and a stock-for-stock deal, which was also tax-free. So he gets very good tax advice. So tax-deferred compounding is the real secret of Warren Buffett, but that relies a lot on not losing money because it's a long road back. But why does Buffett have $1/3 trillion in cash right now? He sees what I see. He sees what's coming. And the great thing about cash is the exact opposite of leverage. Leverage increases your volatility. Cash reduces your volatility. And I recommend, even in a portfolio where out on the wings, you've got volatile assets. Gold can be volatile. I like it, but it can be volatile. Stocks, certainly volatile. Bonds can be, etc. But if you have a slug of cash in the middle, you can still own those volatile assets and make money, but it reduces the overall volatility of the portfolio so you can sleep better at night, number one. Number two, people don't understand, it's not a big return on cash. Well, it's better than it used to be. You can get, depending on your instrument, you can get 3-4% these days on cash or cash equivalents. What has huge embedded optionality, what I mean by that is when everything collapses, you can go shopping. Everyone else is like selling the portfolio, fire sale, in distress, margin calls, got to get money, got to deleverage, can't do it fast enough, and you're losing money all the way down. But the guy with cash can just watch it happen, take a beat. You don't have to pick the exact bottom, wait till it hits bottom, and then go out and get some very good companies or commodities or anything else at bargain basement prices. But you need the cash to do it. So cash reduces volatility, helps you survive, lets you go shopping when everyone else is puking their portfolios, and those benefits are greatly underestimated because they're not really visible. There's no price tag on it. But if you understand options theory, I shared an office with Myron Scholes for 6 years, so I see options under my desk. But if you understand optionality, it's very valuable. Is that I'm pretty critical of economists. I come down hard on them, and I think with some justification. But there are some good ones out there, and one of the ones I like is Robert Shiller at Yale University. And he wrote a book 4 years ago, but it's 4 or 5 years ago, easily available. You can find it on Amazon. It's called Narrative Economics, and I had worked in that field, have for a long time. But he put together a really good book, and he said a lot of what happens in markets, you got fundamental analysts. They're looking at earnings and surprises and risks and present value analysis and alternative investments, et cetera. Then you've got technical analysis, which is I'm familiar with it. I'm not expert in it. I think I use it to tell me where I've been. I think the predictive value of it is low, but it has its fans, and I'll give them that. But he makes the point that markets really are not driven by fundamental analysis or technical analysis. They're driven by narratives. Narrative is just a story. And Wall Street is great at putting out stories, and they don't have to be true. That's the important point. Some of them are, not all of them. But he gives the example of the Great Depression. He said during the Hoover administration, in the late 1929 to 1933, which was the worst part of the Great Depression. It continued after that, but that was the worst part of it.
Markets aren't ruled solely by earnings reports or technical charts, they're driven by stories. Nobel laureate Robert Shiller calls this narrative economics. From the despair of the Great Depression to the optimism of FDR's "happy days are here again," public mood shapes market behavior. More recently, Wall Street's Fed pivot narrative sparked repeated stock rallies, even though rate cuts didn't arrive until late 2024. Stories can overpower facts in the short term, so wise investors observe closely before acting. The downfall of many traders isn't bad analysis, it's human nature. Overconfidence, denial, and refusal to accept small losses often lead to devastating ones. Legendary traders like Bruce Kovner thrived because they knew when to exit. Tight stop losses, discipline, and emotional detachment separate professionals from amateurs. As seen in long-term capital management's collapse, even the smartest minds can fail without humility and risk control. In today's unpredictable world, survival often beats brilliance in the long run.
Yeah, unemployment was 25% and people were broke and businesses were failing. It was pretty bad, but not everybody was broken. Not everybody was unemployed. And there were a lot of rich people around. Just look at, Hollywood and Joseph P. Kennedy and a lot of others. But it became very gauche, I would say, to show off your wealth. Like, don't have a fancy car, don't wear a fur coat. It was just, people were suffering. Don't put on your best jewelry or your fur coat, whatever it was. That was a narrative. But it hurt consumption. It actually made the Depression worse. It wouldn't have been a bad thing if people had spent money. That might have been what it would have taken to get the economy moving again. That all changed in 1933 with FDR. And remember, the theme song of the 32 election, 33 sworn in FDR campaign was "Happy Days Are Here Again." That was the Democrats' theme song. All of a sudden, the narrative shifted. And it's like, yeah, let's go buy that car, buy that house, wear a fur coat. And the stock market did extremely well in 33, 34, and 35. And it was in the middle of the Great Depression. You had a rally. Now, it crashed again in 37 and 38 because of the Fed. So what you really had were two severe recessions inside of something called the Great Depression. And if you say the Great Depression lasted from 1929 to 1940, I think that's right. But there were two separate recessions, 29 to 33 and 37, 38. But a little boom period in between it in 33 and 36. It was because the narrative changed. I mean, the economic policy didn't change all that much. So what are some of the narratives we've kind of lived through recently? Well, remember the soft landing? Remember the Goldilocks economy? This idea. My favorite was the pivot. So the Fed started raising interest rates in March 2022. They stopped raising interest rates in, I believe it was June or July 2023. They took them up, 5.5%. It wasn't the highest rate ever, but it was the fastest increase of that magnitude ever. But as early as the late summer of 2022, not long after the Fed started raising rates, Wall Street came up with this narrative they called the pivot. The Fed was going to pivot to rate cuts. And so it gave stocks a boost. So I knew they weren't. They were still raising them. And I watched it all through late 2022, all through 2023, all through 2024. It wasn't until September 2024 that the Fed actually cut rates. But for those 2 years, everyone on Wall Street is like pivot, 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 get ready for the rate cut. But every time they said it, stocks went up. And I was watching this, I was thinking, well, okay, if you said it once, then maybe stocks should go up once. But how come if you say it 5 times, they go up 5 times and you're wrong every time? But that was a good example of a narrative that had power, that affected behavior, that was not rooted in reality at all. The Fed wasn't anywhere close to cutting rates, but Wall Street talked it up. And so when I see those narratives, I probe them, and it's pretty easy to see which ones are false. Now, you don't run right out and short it right away, because as you said, Rick, and you're right, you can lose a lot of money being right. I knew the Fed wasn't going to cut rates, but I didn't want to, at least at the time, but I didn't want to bet on a rate cut because, bet against it because the market was taking the opposite view. So that's where you bring in behavioral psychology, and that's really what Shiller was talking about. So the short answer is, watch out for narratives. Some of them are true, but a lot of them are false. But they all have power, and don't fight. Understand that the narrative is false to get ready for your next move, but don't do it right away. Don't fight the narrative because you can lose money in the meantime. And as far as long-term capital management was concerned, yeah, over-leverage was an issue. Lack of cognitive diversity was an issue. This is where, the best traders of all time, and I work for some of them, Bruce Kovner, Caxton, and others, they're very good at stopping out. Like, put a trade on and lose a little bit, just a little bit, they'll get out of the trade like that. That's nature's way of telling you made a mistake. Now, most traders, and this is where they all go wrong, is like they lose money. Like, well, it just got better. The trade just got better. I'll do more because, it went against me, so I'll do more at a better price. And then it moves against them again. It's like, well, I'm right, the market's wrong. I'm just going to double down. And they double down until they've lost all their money, and then they get fired. And the best traders will have tight stops. They'll get out as soon as they lose a little bit. They'll get out, get a good night's sleep, come back, maybe put it on the next day, maybe not, but live to fight another day. That's it runs against human nature, but you kind of need ice water in your veins to do this well. And it's very good advice. And I got to say, the best traders I ever knew, and I would put Bruce Kovner in that category, were very good at that, at having tight stops.